Ladies and gentlemen, welcome back to the channel. Today is really another crazy day in the stock market. You are seeing massive fears today, yet again in the banking sector, but this time it has to do with Credit Suisse over in Europe. This is affecting our markets dramatically, and it's pretty interesting. It's not really affecting the regional banks anymore, it's affecting the large banks. Your Goldman Sachs, your Citis, your Bank of America, your JP Morgan. Those were some of the biggest losers on the day. So we're going to get into that. We are going to get into all of the data that is behind AMC and what is really happening with AMC as of right now, because I think this needs to be said. So let's get into all of this information. Hit the like button and subscribe to the channel if you have not already. So AMC down about 10% on the day. Now, it's hard to tell how much of this is due to the vote that we seen yesterday or the panic that we're seeing today in the banking sector, because after all, the Russell 2000 or Russell 3000, all of them, they're down about 3% across the board. So your small cap stocks getting sloshed out today. It's bloody on Wall Street, especially in your small caps. Even the Nasdaq down almost 2%, S&P down 1.5%, Dow down about 1.5% as well. So it's hard to tell how much of this is due to the vote and how much of this is due to panic on Wall Street. But nonetheless, AMC is down 10%, currently sitting at $4.17.5. Now, when you actually look at the data here, not too much has actually changed since yesterday. When you would have expected to see the cost of borrow rates plummet, you would have expected to see the short interest plummet. That is not the case, and that is likely because the court proceedings make it so nothing is finalized here, and we'll talk about this more in the next video. There's been a lot of confusion on this whole court date scenario, who voted yes, who voted no, and we'll clear that up in more detail in the next video coming out later today. Nonetheless, it's not likely, in my personal opinion. It's not like it's a home run trade yet. Until we get to April 27th and hear what the judge has to say, it's not a home run. Now, the markets, if this is mainly due to the vote yesterday, if this 10% drop is due to that, the markets are certainly looking at this like it's going to happen, like the court proceedings are not going to matter. Now, I think that's where a lot of potential opportunity could come in, because there's a very real case here, and at the very minimum, it's going to take months and months before this thing is resolved, before this conversion would actually take place, and that leaves a big opportunity for an upside move from here, especially given all of the red that you have seen as of lately. So, like I said, we will elaborate on that more in the next video. Let's get into some of the data, but first, before we do that, let's talk about Credit Suisse and the situation actually happening today and what the markets are pricing in from the Fed. So, the markets are expecting the Fed to pause interest rates March 22nd. That is going to be next Wednesday. You're expecting a pause, 60.1% chance. 25 basis point rate hike odds sit at 39.9%. So you are expecting a pause. Now, is this bullish? This is the question that a lot of people want to know. Is this bullish? Not necessarily, because you went from pricing in a 50 basis point rate hike a week ago to a pause now. That's not necessarily a good thing. And it's not a good thing that the Fed and the Treasury and the FDIC have came out with this proposal to save the banks that have went under, or at least save the depositors that went under, that had deposits at these banks, but the banking system is still failing. Keep in mind, it's not usually the first bailout that causes fear in the markets. It's usually the following bailouts. Think about COVID 2020, right? The Fed came out in late February, cut rates the first time, and it wasn't such a big panic. And then the next time they had to come out and cut rates essentially to zero is when people started to panic because it was not enough. Same thing in 2008. The initial bailouts were not enough. They had to come out, do more stimulus, do more bailouts, and that's where the actual pain did start to set in. Now, the interesting part about all of this with the banks is in the back of these banks' minds, right? They thought worst case scenario, they could come out and raise capital, right? They could come out, issue stock, raise some billions of dollars, they would be fine. Not anymore. If you do this, or if you do that, I should say, you are going to be obliterated. No matter what bank you are, no matter if you are the largest bank in America, JP Morgan, or you're a second-class bank, you cannot come out and raise capital. That's the same thing Silicon Valley Bank tried to do. So the share price of these banks going down does affect the actual business and does make things a lot more rocky going ahead. And you can see that with SVB, right? If their share price had remained $200-300 and the markets would have let them raise capital, they would have not been in this situation. As soon as they said capital raise, people are like, why is this bank got all of a sudden raised capital? Not a good thing. So the operating environment becomes a lot harder for these banks as there is more fear as banks start to go down. And this whole situation with Credit Suisse is not good because people were expecting some kind of bank instability over in Europe, but not this fast. Now, Credit Suisse is not a stand-up bank in Europe. They've had their set of issues, but we didn't expect this soon. So this article says financial shares fall as Credit Suisse becomes latest crisis for the sector. Shares of the Swiss bank slid after its biggest backer said it won't provide further financial support. The move appeared to be hitting large and regional U.S. banks as well. While Credit Suisse struggles appear unrelated to the mid-tier U.S. banks, the combination of the two issues could spark a broader re-examination of the banking system among investors, according to Peter Brockvar of Bleakley Financial Group. So, yeah, like I said, they've had their own set of issues. They lose like $1 billion every 3 months. Their stock is like $1, right? It hasn't been a good bank for a long time. But it is starting more fears of this contagion in the banking sector. Overall, not a good thing. You can see the numbers right here. Russell 2000 down 2.6%, NASDAQ down about 1%, S&P 1.5%, and the Dow down about 1.65%. You can see oil down about 6% on the day across the board. That is very deflationary. That is showing fears of a recession. And if you look at the bond yields, the 10-year bond is down about 18.5 basis points, sitting at 3.45%. So if you actually go ahead and take a look at this, the 2-year, 10-year spread. So let's go ahead and look at this. What do you see happening right here, right? You were massively inverted in March 8th of 2023 is when you had the worst inversion, down 1%. You are uninverting in the yield curve. This is actually when the pain starts. When the yield curve inverts, that's not necessarily a sign of all hell to come. But when the yield curve starts to uninvert, the way that we are seeing right now is when the pain tends to come. Look at any other crisis. Look at the dot-com era, look at the 80s, look at 2008. The pain didn't happen when you were inverting. It happened when you were uninverting. And that's exactly what you are seeing now. So there's a real chance here that this is the start of the 2023 recession. So pretty interesting. And this is something to very much pay attention to because you have not seen a yield curve inversion get basically uninverted this quick in pretty much ever. I mean, March 8th, it's March 15th. March 8th, you were inverted 1% or 1.10% on the 2 and 10-year yield curve. And now look at that. I mean, you're only inverted 0.42. 6%. So pretty interesting. Pay attention to that one. Now, as far as everything else that you need to know on the day, retail sales came in worse than expectations, about 1 point worse than expectations, negative month over month. And then you also did get, what was it? Let's go ahead and pull it up so I'm not botching these for you guys. And I'm on March 21st. We gotta go to March 15th. So PPI month over month, that was forecasted as 0.4%. It came in at negative 0.1%. So that was very good on that side. Retail sales expected to come in at negative 0.2%, came in at negative 0.4%. Not necessarily good again in terms of a recession. And that was all you had for economic data. As far as economic data coming out tomorrow, building permits at 8:30 in the morning. Initial jobless claims at 8:30 in the morning. That's about it. On Friday, the Michigan Consumer Sentiment Survey. That's going to be the important one coming out at 9 o'clock in the morning. On Friday, and you want to see inflation expectations. So there is that. If you take a look at the live short interest offer float on AMC, 24%, 124 million shares currently sold short. Cost of our average 236.93%, cost of our max 315.33%, and cost of our minimum at about 1%. If you take a look at Interactive Brokers short availability, 122% cost to borrow rates. With about 500,000 shares available to be lent out. Now, you would have expected to see cost to borrow rates actually fall quite a bit at this point. If this trade was essentially over, the volatility should have went away, but with these court proceedings, it's going to be volatile for a great deal of time to come. If you look at AMC on a technical basis, you have broken under $4.50 per share. You want to stay at $4.50 per share. You want to see a rebound by the end of the day today. I don't know if it's going to happen. You want to see that by the end of the week. You want to see that in general, because under that, really, I mean, the only other support level you have is the low of 2022 at about $3.75 per share, and I don't necessarily think we are going to there. I think there's a greater chance we bounce to above $4.50 per share over the next couple of days here. So that is going to do it for this video. We have much more to get into in the next video, so stay tuned for that one. Hit the like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. Thank you guys for watching, and I will see you in the next one.